What's up, investing legends? Today we welcome Jordan Canino to the program. Jordan's path into real estate was anything but traditional. From Wall Street roots to law school and a brief stint working as a sports agent, he eventually found his way back into commercial real estate, where he has built his career in self-storage acquisitions and capital raising. Today, Jordan serves as the Senior Director of Investor Relations at Hearthfire Capital, where he works with everyone from individual investors to larger institutional and joint venture capital partners across the firm's self-storage platform. We kick up the episode with Jordan's origin story and how he made the jump from law and brokerage into the self-storage world. Later, we dive into why self-storage has become such a compelling asset class, how experienced operators evaluate market supply and demand, and what really makes a storage deal worth pursuing. To wrap up, Jordan shares his outlook on self-storage in 2026, where he still sees opportunity in today's market and the investing principle he believes matters most when choosing who to invest with. If you're looking to better understand self-storage, passive real estate investing, and what it takes to identify durable opportunities in a crowded market, this episode delivers practical insight from someone who's been actively sourcing, underwriting, raising, and deploying capital in this space for years. So without further ado, everyone, let's welcome to the show, Jordan Canino.
Welcome to the Investing Secrets Podcast.
Jordan, welcome to the vault.
Thanks, Danny.
Yeah, it's great to have you here, man. And I'm excited to dig in, to the self-storage world. You've been all over the place, though. You didn't start in self-storage. You got a law degree and you worked in brokerage for a little bit, and then you started raising money. Look, walk us through the path there, and then, what eventually led you to being involved with Hearthfire.
Absolutely. So my path was not a straight line by any means. I graduated college in 2006, got into private equity real estate right around the end of 2006. And 2 years later, there was, the giant crash in the real estate market that everyone's aware of. At that time, I went back to law school to get my law degree. My goal and dream as a kid was to be a sports agent. So in order to do that, I needed my degree. So I thought, it helps to have your degree, but you don't really necessarily need it. It was still great education, great experience. Out of law school, I started moonlighting for an agency, a sports agency out of New York, uprooted my wife and fiance at the time to move to New York. And then after about 6 months in that world, decided it really wasn't for me, and a lot of late nights and a lot of BS. And I learned pretty quickly that industry was very difficult and very dirty. I didn't want to spend my life chasing guys and then to lose them at the end with a bag of money in the bottom of the ninth inning, So it was a great experience, and I wouldn't do it any other way. But after that, got back into real estate, started really with working for JLL and Colliers on the brokerage side, doing a lot of industrial work. And from there, was recruited to become the director of acquisitions for a Philadelphia-based storage company who at the time had about 25 facilities, and they were looking to double their footprint over the course of 2 to 3, 4 years. I had some experience in storage on the brokerage side and really loved the industry, but I had never really dove in and learned all the players and the markets and all of that jazz, but soon caught up. And when I was at the helm, we bought about 14 facilities in 2 years. And from there was recruited to run the capital markets function and fundraising for another company out of Baltimore. Fast forward about 7 years, and I worked for 2 other shops, but now with Hearthfire, I'm the Senior Director of Investor Relations, and I handle basically all of our existing investors as well as our new leads and bringing in new capital from all the way from the bottom from our retail side, the folks that are investing 50K checks, all the way up to more institutional, larger JV partners. So yeah, that was probably the quickest version of my story that I've ever done, but I think I've gotten good at it over time.
I love that, man. Yeah, no, it's funny. We start to refine the SparkNotes version of our background. So yeah, man, I mean, look, like, I think it's a really interesting kind of like come up to where you are today. And For those that are sitting at home that have never explored self-storage, give us the 30-second elevator pitch. Like, why should I invest? Why should anyone invest in self-storage?
Yeah, absolutely. So for one, it's pretty recession resistant. So as an asset class over the course of the last two recessionary environments, storage occupancy has remained very, very solid. As you can imagine, in a recession, when there's a lot of downsizing and dislocation, those are big drivers of the industry, right? So from a general macroeconomic outlook of storage, in a good economy and in a bad economy, people need to store their stuff, right? And the American consumers, and Europe, it's very big now. A lot of places, people live in smaller dwellings and they accumulate crap, and they don't. So long as they don't use the trash can as an alternative, it's I've been saying this forever. It's there's always demand for it, right? So from that standpoint, it's an unbelievable asset class within real estate. And then just from a overhead standpoint and expense and income standpoint, sometimes there's assets that are making 75% margin, right? So your expense ratios are very light. You have your staffing, which is one or two folks. You have your taxes, which is normally your highest expense. Your marketing expense, and then, utilities are very light, but, you're able to really take the top line and keep a lot of that revenue. So you're able to get deals that are high teens, low 20s IRR deals all day. So long as you execute on the business plan. And I've been around storage a while, and I've seen a lot of people execute, and it's not rocket science. It's find the right management company to manage your asset. Well, first, find the right asset, right? Has to be in the right market. Supply and demand is huge, right? You don't want to go in a market that has a new competitor or someone who's in the pipeline to build, or numerous people within your trade area. And then really executing on your business plan is a huge part of that is who's your management company. We, as a company, only use Extra Space and CubeSmart to manage. They have they have a great management platform, great track record as publicly traded REITs. As you can imagine, they're pretty buttoned up, and they handle a lot of our criticism and critiques very well, and they're able to implement the strategies that we're going to use, whether it's a value add acquisition or whether it's a ground up development. Obviously, it's different depending on your strategy and how much concessions you're using, and how to lease the thing up, but then get it to market rents or even higher for the leader in a market. But yeah, that was a lot of talking about storage. I mean, other than that, the people within storage are awesome. It's a small community. There's only 60,000 facilities in the country, and most middle-sized, large owners know each other. And we go to conferences and we share data and we share information, and there's enough to go around where the vibe it's chill and it's collaborative. So that part of it I love.
Well, you said something there, and I'm genuinely curious with CubeSmart and the management companies that you use. Are these like franchise models, or how does that work? Because obviously these are brand names that I recognize, and so I'm wondering like how that relationship works when you own the asset, right? So walk us through that.
Yeah. So all of the larger management companies, all of the REITs, they all manage for other folks who own facilities, right?
Got it.
Generally, the cost is between 4 and 6% off the top line revenue of a management fee. So you can envision it almost like a Hyatt or a Hilton branded hotel, which I know you have experience with, where that's the flag, that's the brand, they manage it, and you pay them a management fee. There is no equity upside for them. They basically get their share of the top line revenue, and they're incentivized to do a good job, right? They get 5% of the revenue that's coming in. So if they do a good job and everyone's happy, then they do well. The other thing is that those companies also, CubeSmart, Extra, Public Storage, the big three, they also acquire assets. So they develop and they acquire. So for them, it feeds their development and acquisitions pipeline to manage, right? So they're able to, they have the ins to potentially buy it once we're ready to sell and the assets are mature. So it's also another benefit of having them as managers, because generally they're able to pay more than a mid-sized, even larger size private equity shop. They need to acquire assets, like they're publicly traded. Building their pipeline of assets is important. So for them, building their pipeline of management agreements with groups like us is also important. Yeah, that's generally it.
That makes sense. So my assumption is that you're not operating under that flag or that brand. You are operating under the brand. We are. Like if you saw one of our facilities, you wouldn't be able to tell if Cube or Extra owns it or we own it. It looks like a Cube or Extra building. The person working at the desk has their green or orange shirt on or red. Got it.
So yeah.
Okay, cool. That's actually it's interesting. It's a little bit different than I would say the hotel industry, because in hospitality generally, you're paying two things. You're paying for the franchise fee, right? Which is the brand, Marriott, Hilton, whatever. And then you have to pay the management fee. Which what is, are those costs? Well, the management is usually 3%, and the franchise fees are generally somewhere between 11 and, well, on the low end, like maybe 6 or 7 to like 13 to 15% on the high end.
Right.
And that
so the
includes,
economics, they're completely different. The economics.
Yep.
Basically, what I meant was that it's flagged them, but they don't necessarily own it.
Yeah. So you're buying the brand name, which is very useful, right? Because people recognize that and they are more likely, right? I mean, assuming that there's brand equity there and it's not a brand that has a negative reputation, then it's going to help, right? So that's really interesting. Okay, cool. So let's take a step back. What makes a good self-storage deal? What makes it like when you're looking at a self-storage deal, what are the things that Hearthfire is looking for to assess whether or not it's a good opportunity for them to acquire?
Yeah. So there's two main things. You look at the first thing you're going to look at, and just to be clear, every market is really a 3 mile to 5 mile ring, right? So even within New York, Philadelphia, Miami, Chicago, people can say that the market is oversaturated or whatever, but it's really based on what it looks like 3 miles or 5 miles or even 1 mile in a dense area around that area. So when we look at a new opportunity, we draw that radius around the asset or the property, and we run a supply and demand analysis, right? So generally they say that national average is 8 square feet per person throughout the country. So 8 square feet of self-storage per person in a market. If it's above 8, it's oversupplied. If it's below 8, it's undersupplied. General rule of thumb. Obviously, it's different. There's some areas that 20 square feet per capita is the true demand, right? But on average, if we see an opportunity to buy an asset or develop a asset in an area that's 4 to 5 square feet per person in that market, that's a good sign. Okay,
sure.
We then do a deep dive of what that supply really means. How much is climate controlled? How much is newer? Are there other assets that are in the pipeline to be built? When was the most recent asset built? How does that occupancy look over the course of, call it a year, 2 years, whatever? And then that's really our supply and demand competitor analysis. And then we look at rents, right? Rents are super important. So we don't develop for less than $18 a foot on an annual basis from a revenue standpoint. And from acquisition, it really starts at 15. So if a market isn't bringing in that money based on comps that are within a mile or 2 miles, it doesn't work for our investors and the returns that we go after. So supply and demand, rents, obviously, has there been some macroeconomic activity in that market, right? We just bought an asset in Syracuse. Micron's moving to that market, bringing 80,000 jobs. We like that story. That's always an added bonus. We bought and built an asset in the Detroit market because all of the AI companies are being headquartered out there. So it's, those things drive a lot of our decisions and help with the story for us. I guess another thing to look at, a metric we look at, is owner to renter percentages, because renters generally use storage more. Owners might have a garage or a basement, and more land or space within their house. What else? Have there been recent multifamily starts, and how many units have been delivered? Those are all things we really look at. But yeah, that's generally it. And then we put it all together and run the model and see if it works and go after it. What's been difficult recently is finding good deals and deals that are priced right? Land's expensive. Sure. Buying existing facilities is very expensive. There's still a dislocation between sellers and buyers. Sellers are pretending like cap rates are at a low or at a high, and they think that they're going to go down, which might happen. And buyers just want to allocate capital. So it's just, I'm waiting for, we're bidding on 4 projects this week, but we haven't had a new deal in about 3 months. And so we wrapped up Syracuse Rays, we're wrapping up Whitehall, and I'm on the acquisitions team to get us some more deals because we have some capital to deploy.
Interesting. Yeah, that's the $8 a foot. That's something that I didn't know before.
8 square feet per person.
Yeah, 8 square. Yeah. 8 square feet per person is what I meant. Yeah, not $8 a foot. Yeah, 8 square feet per person is an interesting metric. And you're looking. That's like you're saying, like, what's the supply look like, or what's the market saturation in a 1 mile, 3 mile, and 5 mile radius? Trying to like figure out, because maybe within a 1 mile radius, it's less. Like what happens if it's like in a 1 mile radius, it's less, but in a 3 mile radius, it's like $12.
You mean 12?
I mean, 12 square feet per person. Yeah.
It's probably not a good sign.
Yeah.
It's probably not a good sign. It depends on how dense the market is, right? So if the population is really dense within that 1 mile, and you have enough people to come from just that 1 mile, there's a story there, right? Yeah. It's also important, when was the last facility that was built within the 3 mile, the 5 mile, all of that. But you look at that as a whole. Most markets are 3 mile markets. People don't want to drive more than 3 miles to put their stuff in storage. Yeah. As you get more rural and out in the boonies a little bit, it gets wider. It could become a 10-mile market, but we're not really in those markets. We're in smaller primary, secondary markets that have at least 50,000 people within a 3 mile radius.
Got it.
Which generally, yeah.
You mentioned knowing what the occupancy looks like for other storage facilities, like that you're competing against. How would you know what the occupancy rates are for those storage facilities?
So Radius Plus, who's our data provider, provides you with rents. For occupancy, you got to dig further, right? We can ask our management partners, who probably won't tell us exactly, because they, if it's managed by Cube or Extra, they have a pretty good idea of the occupancy.
Right.
We do, we call the facility. We drive into the facility to find out how many 10 by 10s there are, how many 5 by 10s, to get a general idea. But these things mostly, after 3 to 4 years, reach 90%. I mean, stabilization and storage is between 88 and 92%. And every asset in a good market just fills up. If there's new supply and 2 facilities come online, that could push it out maybe a few years. But over the course, on average, these things lease up in 3 years. So you can assume every month you get about 3%.
Okay.
3% of your facility leased up.
And is Hearthfire doing mostly acquisitions, or do you guys also do development?
We do both. We're 60-40 heavier on development these days, I would say.
Got it. Okay. Yeah, I imagine with development, you're able to kind of really position yourself in a market where you feel like, hey, this is going to be a home run for us, because we can, pick our market, pick the location, all those things. Obviously, you can do that with acquisitions, but you're dealt with, you kind of work with the cards you've been dealt, so to speak, right? With acquisitions. Speaking of acquisition, from an operational perspective, like what opportunities are there when you're looking at a property, from an operational perspective? Obviously you've got, there's two ways to add value, right? It's cosmetic, right? And then obviously operational. I imagine a lot of storage facilities that you purchase probably don't need a ton of cosmetic work because it's storage, right? So it's maybe broken this, broken that, but you're not trying to like make a kitchen beautiful again. So I imagine a lot of the opportunity from a value add perspective comes from operational overhaul, so to speak.
Yeah.
Right? So
I call that managerial upside, right? So that's a huge component in our value add. We believe that if we come in with Cuban Extra, we could probably do a better job than Mary and Joe who have been managing it, right? If it is a mom and pop who've owned it. Those opportunities are few and far between these days because many groups like ourselves and larger private equity shops have gone in and bought many of the mom and pops and brought in that institutional quality level of management. So yeah, there's managerial upside. Another huge part of our value add strategy includes development. So we'll buy an asset, call it on 6 acres. We're only using 2 for the current building, and we'll add more storage, right? So we'll do an expansion. Expansion is a huge part of our business on the acquisition side.
Got it.
And there's other ancillary ways you can make money in storage: cell towers, solar panels, RV parking. You got to get creative so long as you can, and there's room for it, and the market supports it. But yeah, the value add side of the business is tricky. Not every asset that we buy needs an additional 30 to 50,000 square feet of expansion space, but some of them do. Some of them, the market just needs it, and we have a deal right now in Hudson, Florida, outside of Tampa, where we bought the existing facility. It's about 40,000 net rentable, and we're taking the additional 5+ acres through entitlements now to double the footprint there and double our square footage. And that deal just worked. We had the additional land. We didn't have to, it was part of the acquisition. We didn't have to go and buy the parcel next door and deal with that. It was zoned by right. So all of that was helpful. But yeah, our value add strategy is deal by deal, entrepreneurial. Sometimes the value add is really buying an asset early and lease up from someone who might be in a position where they have to sell, right? And that's not necessarily value add. That's really just an acquisition of a lease up deal. But
yeah, it's opportunistic. Yeah. Interesting. Well, self-storage has, I think, gotten maybe a little bit of a bad rap recently, and some of the conversations around self-storage that I've heard, at least, right, Jordan, is in a lot of tier 1 markets, there's oversupply. It's become overbuilt, like in a lot of areas. And so what's the response to that? Obviously, you guys have analytics and tools and stuff to make sure that you're not buying into a market that's oversupplied. But seeing as how that's become more and more the trend, what are the steps that you're taking to kind of mitigate that, that risk of buying into a market that eventually becomes oversupplied?
Yeah. So the main thing there is buying into a market that has some barriers to entry, right? You can't just go and buy or build an asset in parts of rural Texas where you can pretty much do whatever you want, or Florida, right? There's parts where you could just go to the municipality and say, hey, I want to build 80,000 net rentable feet here. And there's no one's going to tell you no, because it's bringing, you're taking a piece of dirt and you're putting something on it. You're bringing some jobs there, bringing some, life to an area that might need it. Parts of Maryland, New York, New Jersey, PA, it's very difficult to get an approval to build storage in a lot of these places. They might have a moratorium on storage. They might just say, we don't want any more. They might have a lot of existing supply already. So that, being in a market with some barriers to entry is important. And we're when we go into a new market, or not many new markets, we like to expand within our own markets that we're in. We already know the market. We know all of the storage facilities that have been built in the last few years that are in planning. And that's important. Going back to the math of the square feet per capita in a market, you have to include all of the assets that are currently either in planning or going to be completed by the time that you're open, right? So that makes it even harder to get below the 8 square feet per person in a market. But yeah, oversupply is probably the biggest threat to the success of new opportunities in storage. So you have to be very careful in knowing the markets you go in and being aware of where rents have been, right? We track rents daily and, chart them over the course of the last 12 months, 24 months. Beyond that, it's kind of difficult to analyze. But if rents are going down in a market and the supply is going up in a market, that tells you a story right there, right?
Right.
If the rents have been increasing and supply is burning off, and there doesn't seem to be a supply issue. Rents have been flat in storage over the last few years. Coming out of COVID, if you underwrote a deal to 3% rent growth year over year, you were wrong, right? So if you see a market that's flat, all right, pretty much average. If it's declining and the rents have been declining over the last 12 to 24 months, something's going on there, right? Is it mismanaged? Is there new supply? The consumer, the demand is going up year over year, right? That. Maybe there's too much storage and the population, there might be some decline in population. We like to always see growth of population as well. It's one of the metrics we look at. So yeah, just, there's a lot there. There's a lot to look at and analyze.
Yeah. I would assume so. And I don't know a ton about self-storage, but I know enough to know that there have been a lot of individuals who have invested. And the thing is kind of take a step back, right? Like, I think a lot of the areas that have been overbuilt, right? Like a city that I know for sure has been overbuilt is like Austin, right? And everything's just like an oversupply issue there of pretty much everything now, right? I think it's like these buzzword cities, right? Like these cities that kind of like have a Phoenix. Yeah. I actually didn't hear Phoenix before, but I guess that kind of makes sense, right? Because, Phoenix always seems to get hit hard during, any recession, man. They got pummeled in 2008 and pummeled right now. Poor Phoenix. Easy to rise, but easy to fall too, for those guys. Yeah, it's interesting. I think like Austin, like some of these cities, like they're sexy, right? And so, but it's easy to fall into the trap, right? Oh, we're going to build a storage facility here in XYZ city. And then, you lose all your money because, there's 5 going up within a 1 mile radius, as you mentioned, right? So it's hard to, it's interesting dynamic there. And, it sounds like the lower, like as far below 8 square feet per person as you can be, the better, right? Like the lower that number is, the better. It gives you more room, like more wiggle room. Are there situations where you're like, hey, like we're at 7.5 and like that, like we just anticipate over the next like 3-5 years that it's going to get pushed over 8 and we're probably going to be oversupplied? Yeah.
And you got to look at the whole picture, right? What are rents? What's the trend of the rents? Like I said before, when has the last facility come online? What do the occupancies look like in all the facilities around you? All of that is played into it. There's parts of South Florida. I remember when I was in the acquisitions phase of my career, we looked at an asset in Pompano or somewhere near Fort Lauderdale, and the square feet per capita was like 15. Okay. But every asset was full and they were all older. They're all like 1990s built, early 2000s.
Right.
And it just needed more storage. It was crazy. There was just a lot of demand there. A lot of people live in smaller homes. I guess it's a transient area that people move in and out of. But yeah, it's a rule of thumb, but you really have to look at the whole picture for every opportunity.
Sure. Yeah, that makes sense. That makes a lot of sense. Switching gears here a little bit, Jordan. What are some hidden or like maybe unknown benefits that are associated with investing into self-storage facilities as an LP, right? Like as a passive.
Yep. Great question. So obviously, in addition to the returns, which are great, and passive, which, you know, have its benefits for people that are okay with being passive. Bonus depreciation and cost segregation is a huge bonus to our business, not to reuse the word bonus, but for every asset we buy or build, we do a cost seg study, which allows us to accelerate depreciation to year one of every asset that we buy or build. And what that means, roughly, we'll just use $100,000 investment. On average, about half of that investment you're able to utilize in year one to offset some of your other passive gains that you have in your portfolio. So that is an extremely tax beneficial and interesting tool that many of our investors use. It's also able to be carried forward. It's also able to be used against distributions from the asset. So, you know, no taxes for a certain, you know, up till that $50,000 law, you know, it's basically a lost bonus depreciation. So that's huge. Folks are able to 1031 into and out of our projects. So we have folks that come in through a tenant in common piece of our capital stack, and they invest through a sale of any other piece of real estate that they've had, so long as they do it within the time frame, and it's you know, they have it through the intermediary and all that good stuff. And then for our investors that leave an asset, we generally offer them a 1031 potential to invest in another one of our projects and to roll the tax forward through 1031. What else? And those are the main ones. You know, high teens, low 20s IRR deals are great too. So have to reiterate that. Like we're 2xing our investors' money over 5 years, and if we can't do that, the deal doesn't pencil for us. We're not a group that's buying core assets, you know, coupon clipping core assets that are giving 8 to 12% to our investors. We're really in growth markets. Our growth platform is heavy value add and development. So, yeah.
Cool, man. Yeah, it's the bonus depreciation or coming back is huge, right? And obviously being able to capture a lot of that year one is massive. So on average, sounds like 50% or so for year one.
Yeah, some assets are around 40. We have an asset that is about 80%. It all depends on the cost seg study. You know, they come out and they run the report on what can be accelerated from, you know, 27 or 39 and a half years to 1 year, and what is considered depreciable and all of that jazz that I don't really get involved in, but I tell the brass taxes of what it looks like on your K1, you know?
Yeah. Love it, man. Well, we are coming up here on time, Jordan. Couple wrap-up questions here for you, though. Like, looking forward, we're sitting at the beginning here of 2026. Obviously, no one has a crystal ball, but you know, how do you see the market shaping up this year? Maybe in the self-storage space, since that's your, you know, what your bread and butter, but then also maybe like just general real estate forecast here, what you expect to see kind of throughout the year.
Yeah, I mean, I think I can speak for most folks by saying that interest rates will slowly start coming down even more. I know that that's been, you know, rumored to have been happening, but hasn't really taken full effect yet. So I think at some point interest rates will go down. What that means, we'll be able to borrow money for cheaper and buy assets and pencil more deals, right? What it also means is that cap rates are going to follow at some point, and the price of those assets is going to go up.
Right.
So, you know, it's a double-edged sword. If you could convince a seller that cap rates are still behind, they're lagging, right? And you're not going to get a 5.25 cap. We're going to pay you 5 3/4 with cheaper debt. Now we're talking. But I think that that's definitely something. I was just at a conference last month. I'm going to a conference in San Antonio next month. So I'm sure that'll be the talk. In terms of opportunity, and I still think there's tons of opportunity to develop in good, solid markets that have good growth stories, both multi and storage. I mean, that's kind of, I track multi as well because it's just as a direct effect on our business. But yeah, I mean, that's, I'm not a economist or a prognosticator when it comes to, anything like this, but that's my gut and what I hear. Beyond that, I don't, my forecast is for us as a company to do 8 projects this year. We're about to finish our second. So we got work to do. We got 6 projects left. And from my standpoint, that's a lot of money to raise, right? Our average deal is 15 million. That's around $4 to $5 million of equity. So I got my work cut out there.
Sounds like a fun time, man. Oh, man. Well, I agree with you, by the way. I think, come May, once Powell, once the Fed kind of changes out the leadership there, I expect whoever comes in is going to have a mandate to kind of start bringing things down. Now, we can get into debates as to whether or not that's smart or not. I'm not here to debate that right now. I'm just here to say, I think it's pretty obvious that the current administration wants to bring some life into the economy. And I think that the way that they're going to try and do that is by bringing someone in that's going to be able to, not dramatically, but probably slowly over the course of several months and years, bring down rates. Not to where they were before, man. Not to where they were before. So I think there'll be some happy medium there, but enough to stimulate the real estate market. And I agree with you. Everyone was, can't wait for rates to come down. It's like, well, yeah, rates will come down and prices will go up. So, I mean, you're kind of waiting for paint to dry. I don't know. It's going to be a slow burn, but, it'll be an interesting one. We'll see what happens. And, maybe the rates coming down might also, it might also save some folks, who have been in hot water for the last couple of years, and they're finally able to kind of refi into a product where they're able to manage the debt service, which, I think might save more actually than a few folks. So we'll see what happens there. But, Jordan, before I let you go, man, this has been awesome. Thanks for stopping by. I can't let you leave the vault though without leaving the audience with one final investing secret. Take it away.
Investing secret. Invest with a person or a group that you like and you trust and that you could bring to Thanksgiving dinner.
I like that. All right. I like it. I like it a lot.
Yeah.
I mean,
I don't think I've ever
trust.
said that before.
Yeah. Bring him to Thanksgiving dinner. Introduce him to mom.
Exactly. Introduce him to Aunt Kathy, the alcoholic.
Yeah. They'll have a blast.
Yeah.
That's awesome, man. Well, Jordan, thanks for stopping by, man. Such a pleasure to have you on, and look forward to seeing all of Hearthfire's success over the next year and beyond.
Thanks, Daddy. It was awesome, bro.